Good day, all. Ira Epstein of Linn Associates, back from the Memorial Day vacation. I played hooky. I took Friday and Monday, of course, off. Nobody worked Monday in the futures business, but interesting times. And today is Tuesday, the 28th of May, 2019, and we're getting on to 4:45 p.m. Another down day in the stock market as traders keep plowing into bonds, notes. They're telling you they don't like what they're seeing. When they keep driving interest rates down, and you think of how far they're at, I think you're under 2.3 now in the 10-year yield. This was a market that was 3.25% recently. So it's lost back everything, and you're getting inversions where the front end is offering as much money as the back end. Why the heck invest long term here? So big problems going on in this market, and you're seeing it in stocks. You're starting to see some deflationary thinking, I think it is going on, in the metal markets. The dollar index just doesn't back off. It keeps going on up here. And look at the euro. Remember what I kept saying, if you're going to go to Europe, this is the year. 111.77 today you got down to. The British pound down another 59, but that's a different game. How do you trade that is the problem. Energy's a bit higher. And you know, the premium that keeps going is Brent over WTI. Why not? Think of the problems in the Middle East. Who's going to decide what to do with their oil? OPEC plus Russia. That'll be the decision making, and that's June 25th, that next meeting. When we look at a weekly area chart of closes, we've just gone from 29.4750 down 142 points. We're at 28.05. So this market's in a corrective stance. No ifs, ands, or buts about it. You can see how you've almost got a trend line coming down here. And if you can break through this, you'll hear people talk, we've got a move that's gone from here to here. Maybe you can get down to the 2650 area. That seems to be a common number that I hear being thrown about by a bunch of analysts. I'm not saying they're wrong. I'm saying that's the number I'm hearing. The pattern I see in the market is bearish. Lower highs, lower lows is measured by the swing line. To break that pattern, you have to get it back over 28.4250, about 37 points higher. In terms of support, I had talked to you last week that I thought that if the market fell, you have first two moving averages to look at, the 100-day and the 200-day. They're still as important as they were last Tuesday and Wednesday when I was talking about them, and the Bollinger Band. And the Bollinger Band intersects right here too. So we've got 2870, 2788, 2786, and 2793. That whole area offering a first layer of support. I will be totally not surprised to see the market try to hold that number. That doesn't mean it has to hold it, but that I think is the number the market will see some support. And I would expect to see the pros take money off the table there. Why? Because it's the first challenge of those numbers since way back here, almost a month ago. In the NASDAQ, the trend remains to the downside, lower highs, lower lows. I have the same type of support. I've got all these numbers coming together into the marketplace, everywhere from 72.47 to 71.88, right on through there. Again, oversold. So I will not be surprised to see some support show there and see some profit taking. Now, the Dow is slicing through the 100 and the 200-day average. That puts next support at the lower Bollinger Band, 25,186. It is still oversold in a downtrend. Outside day down today. So the number that the pros won't want to see is taken out today's high of 25,717. If it's taken out, you could put the market back to that 18-day average of closes. But as I said, I think the bears have control. It is oversold. I'll be very surprised if they don't take some money off the table at the lower Bollinger Band. And I'll say the same thing about the Russell. No, I won't. Here's why. They've already hit that number. So they had their chance just recently. That doesn't mean they can't take it off the table, but the market played around at the 100-day average for 3-4 days, then it let go, and it's bounced a little. So I'm seeing a market that's a little different here. I'm also seeing a market that's got both numbers in the slow stochastic under 20 today and yesterday. It didn't have it the day before, which was last Thursday. So if it can keep that number, these two numbers, under 20 tomorrow, well, what happens is you embed, and this becomes, I think, the most aggressive of the shorts in the marketplace. In other words, the most bearish of the market for the short sellers down the road. We did not have an outside day down, so it still gives you 3 layers of resistance on rallies. In the VIX is just stuck at the 18-day average of closes, oversold. The trend is up, higher lows, higher highs. So I think the pros are buyers right in this 1662, and I think they'd look at Friday's low here, which was 1552 is a number they don't want to see violated. If they could get something going to the upside, which would require the stock market to be down more, maybe we're talking the upper Bollinger Band. Otherwise, probably just playing back into the zone until something gets going. In the bond market, I look at the slow stochastic reading, and both numbers today are over 80. They were over 80 on Friday, and they were over 80 on Thursday. So as much as this is over the upper Bollinger Band, I think on pullbacks, you're still going to see willing buyers in this market. 10-year note trying to do the same thing. Both numbers over 80 today, both over 80 on Friday, but. Not so on Thursday. So you need one more day of an up here. The one thing I teach is I tell people, I think you can always do better than not buying over a Bollinger Band and not selling under it. I think the pros are going to take advantage of you there. That doesn't mean I'm telling you how to come into the market. I'm saying in what I teach in my course is not to buy a Bollinger Band. When we look at TLT, it's running right with the other markets. Higher lows, higher highs, embedded reading. So this is as bullish as the other markets are. The dollar index, squint a little bit. Look at the top Bollinger Band and the bottom. You're really in a sideways market. You can get a downtrend going if you were to take out on this pattern 97.41, let's say. That could give you lower highs, lower lows. But right now, if it rallies, I see the Bollinger Band as resistance. I see support, the 18-day average of closes. In the eurocurrency, I think you're out of a trend. You have a lower low and a higher high, and similar to the dollar, I think you're caught in this narrowness right here. Yes, you step out from time to time, but you just seem to pull right back in to that sideways action. In the British pound, the trend is down. You've got lower highs, lower lows with an embedded reading. Just plain bearish. In the Japanese yen, lower highs, lower lows, but that's nullified because prices are staying over the 18-day average. Remember, we talk about filters on other indicators. That puts you to the sidelines on the market at this point in time. Momentum has gone flat in the market as well. Bitcoin, I still see a market that's staying over the 18-day average. The bias is up. The slow stochastics are bullish. They are embedded. Market's got the higher lows. Now it's got higher highs again. Could be targeting the 92.80 level, the upper Bollinger Band. In Brent versus WTI crude, you're back up. You were just down into the $6 range, and once the tensions with Iran began, once OPEC refused to do the production cuts that the president asked for, and then they had that meeting just a couple of days ago, last week, I think it was last Sunday, where they said, well, at our next meeting we'll discuss what we can do. And what they really let the cat out of the bag is they said they can produce more if they wanted into year end and still be within the production cuts because the Saudis and the Russians have cut back so large. So we can get more oil, but not flooding the market. That's what I'm guessing. The problem everybody's worried about is world slowdown. What's the demand look like? When we take a look at the Brent, you traveled from the upper Bollinger Band to the lower Bollinger Band, and now I wouldn't be surprised if you're going for the 18-day average to get neutral. We're going to get the API numbers tomorrow, and on Thursday, the EIA numbers. Remember that. When we look at WTI, come on. Here you go down to the lower band and the Bollinger Band and the 100-day average. This was Friday. I wasn't here, but the market started fighting at those, and all you did today is climb back into the Bollinger Band. It hasn't changed the trend. It is down. It is oversold. So I do think pros have been taking money off the table from the short side against that. In the gasoline market, I think that the pros took money last week off the table against the lower Bollinger Band to see what the market can do going into the driving season. It is interesting that the prices on the natural, on a regular gasoline was across the U.S. actually on average lower than it was a year ago too. You have a higher high, lower low with resistance at the 18-day average of closes. Nat gas is a weather market at this time of the year, so it's waiting for that warm weather which has not yet kicked in. If you're down south, I know you think I'm out of my mind because I know you're burning up down there. But if you take a look at the East Coast as a whole, go up past the Carolinas, if you take a look in the Midwest with all the rain we've had, we've been on the cool side of everything. I haven't really had to turn on my air conditioner much at all. I had heat on it last week, I remember that. Higher high, lower low. I would be surprised if you don't just spin around in this. Notice you had an outside day down today. You went to the lower Bollinger Band, and what did you do? Whoops, you held it and you bounced right back. So, board's clearing behind me, but I'm not through. You know, I talk about my charting course all the time. What it's got is 54 chapters of video. Here's how it works. You see what I do in the chapter. Now you're going to say, well, where do I get the data and all? Because I want to do what he did at that point in time. Our chart data includes it. You go back, you do the same things exactly as I'm showing you. You're going to see in the course, I often remove the name of the chart on it. It's a real chart. It's a real futures market. The reason I do that is I don't want you getting, how do I say this, influenced by the daily news. That's not what you should be trading. You should be trading the chart action, not the daily news. When you pay attention to daily news, it means you look at major reports coming out. Why do you have to go through them? And I say that to Liz Clayman and others all the time. A futures market is not an investment like a stock market. It's more in and out movement in the market. And with these new macro contracts that you see on the S&P, by the way, we trade them as low as now is $1 a side on these macro S&Ps, the Dow, the Russell, and the NASDAQ. Wow. I mean, it's an opportunity. And the margins are 10% lower. So if you don't know about it, call my staff at this number. They'll work that all out with you. But to find out more about the course, just go to the website. It's normally $169.95. It's on sale for the Memorial Day week. It's going to come off of that sale either Friday or Sunday. I haven't made up my mind yet which. We've got people buying it. Don't want to cut it off. And after that, we'll talk Christmas time maybe. See what we do. But eventually I raise the price of the course too, so it won't be $169.95. It'll go up now, maybe $180, something in that range. I'm Ira Epstein. Hope you consider it. I will see you all tomorrow.